welcome to TheoTrade. This is Don Kaufman, April 29th, 2020. Just a few minutes after the cash close, and we're taking a look at a few of the major earnings announcements, both in Microsoft, Facebook. Of course, we also heard from Jerome Powell and the Fed today. But I got to call this a marketplace in denial. Why do I lead off with that? Interestingly enough, Microsoft has come out after the bell and had absolutely stellar numbers, which, all right, in Q1, they were only, minimally impacted, all right, by the shutdown, obviously happening late in Q1. Yet at the exact same time, as I said, the stock is up minimally with blowout numbers. And where's the denial portion of this? When you start to look at Facebook, which is all about advertising. In fact, to further display this, if we take a brief look at this company profile here, everything from Facebook is, it's advertising. And we all know that advertising budgets are being slashed left and right. Well, we heard that from even Google the other day, that Google was clipping their own marketing budget substantially. And henceforth, we got a marketplace that is in a bit of denial here. Now, I don't want to detail too much into Facebook or Microsoft and the numbers because, you know what, frankly speaking, I don't think there's any reason to do so right now. We haven't heard from the conference calls. We'll see what some of the order flow looks like tomorrow morning when it effectively plays out. With that, though, again, the marketplace today rip into the upside once again. First and foremost, I don't look at the marketplace rip into the upside as any surprise. We talked about some really specific levels in some recent videos here. In fact, I'll detail those again in just a moment. But the S&Ps, just prior to the cash open, and again, here we are just prior to the cash open, exploded to the upside. Now, they exploded to the upside, and that was on a really hideous, GDP print, which was minus 4.8%. It was actually much worse than expected. But at the exact same time the GDP printed, we actually heard, from Gilead, which may possibly have something in the hopper, to actually help with the outbreak of COVID-19. Nevertheless, the marketplace loved it, and they completely looked past the GDP number. That's where maybe some of the market in denial kind of comes from. But the point that I actually really want to make is we broke off, the 2911 and ripped to the upside. S&Ps, though, pulled back just prior to the close. This is critical, and I'm going to show you exactly why it's critical with the S&Ps pulling back, because the marketplace right now is actually adhering to what we term expected move. So for those of you that do follow expected move on a day-to-day, week-to-week, or month-to-month basis, we look at expected move quite extensively here. Now, the expected move this week of trade was just about $100. And by the way, if you want a little bit of refresher on expected move, listen, don't just take my word for it that the expected move is around $100. You can always come over here to the Analyze tab. You go to Think Back. All right. And in Think Back, all this is end of day data. We take Think Back and we actually cruise back, and you go, all right, here we are on the 29th. Just cruise back over to the weekend. And when you cruise back over to the weekend, you can actually take a look at the expiration. All right. For instance, a week out. And this expiration, of course, will be the May 1st expiration. You're looking at about just shy of, as I said, about $100, $95.82. And the interesting irony, as I said, the marketplace is adhering to it. Most of your trade today was right in and around, this is the upper edge. Again, the upper edge of the expected move. And it's critical that we keep eyes on this throughout the course of, the remainder of the week, both Thursday and Friday. Is the marketplace going to effectively start to adhere back to it? Do we have premium sellers back in the market? I'll tell you what, we are going to find out. One thing I've also talked about extensively in some of the recent videos was breaking a range. We had a huge issue. I specifically have a huge issue with the fact that the volatility remains relatively high inside of the overall marketplace, and yet we're trapped, like a rat in a cage. And I detailed these particular ranges inside of the spiders, and I talked again on the Monday video about the 290 level, and effectively the 270 level. This is an extraordinarily mild breach of the 290 level, but we're above it. We're above it, and that means, okay, that you're going to see me start to continue to allocate, which is exactly what I've done. Even in today's trading session, I started allocating a bit more capital because we've effectively broken the range. Now, we'll see if there's any follow through to the upside. And again, the fact that we're on the edge of the SPX expected move, I'm just waiting here with bated breath a little bit. All right, so the after-hours trade in both Microsoft and Facebook appears to be to the upside, and that's predicated on the idea that it's taking the Nasdaq futures a little bit higher, okay, and the Nasdaq futures are rebounding to effectively highs of the trading session. Now, before I go any further, okay, you're seeing market rally. Right? And as I said, kind of a marketplace in denial. One other aspect I want to focus on for just a moment, and before I go too deep in some analysis over here, is that the Fed had absolutely unequivocally no impact today on overall markets. In fact, when you start looking at this, okay, you can barely tell where the Fed announcement even came out. And again, what I'm looking at right now is the S&P futures, and right there, this little bump on the radar screen. Okay, but during Jerome Powell's press conference, we rallied mildly. Okay, but just back to effectively where we were in the hour prior to that particular announcement. Is there much of a standout in terms of volume inside of the S&Ps? And I can't say that that's the truth either. So again, I wanted to show you in terms of the S&P futures, we really haven't had much of a huge breakout. There's no huge volume occurring in here. And again, the Fed didn't have an impact in the S&Ps. Okay, the Fed themselves didn't really have an impact much on the bonds either. Okay, there was literally a couple of big trades that went off over here. By the way, these larger trades, well, that was the end of the Jerome Powell press conference when he talked about some of the leverage. But again, really negligible impact of the Fed at this point in time. But you also have to recognize the Fed is probably the reason the marketplace is up the last couple of weeks. And again, approaching, and it's almost hard to say this, approaching the 3,000 level with everything that's effectively going on. This is something I'm going to explore a lot more deeply, of course, on this weekend's video, is the constant disconnect. And that's one thing, again, I've talked about extensively. Right now, forget what you might think, okay, about individual companies, what you might think about their fundamentals over here, because quite frankly, it doesn't matter. This is about sector rotation. Now, I want to once again kind of reiterate one of the positions that I have on here, and the position is being used predominantly as a hedge. I have, again, bullish positions inside of the Russell product. And the Russell product, okay, it has exploded once again up by the tune of 5% on the IWM. And I've had this trade on a number of different ways, everything to ratio back spreads to the upside inside of the IWM, over to pairs trade where I'm actually long IWM and short the QQQ. Kind of ironic when I'm talking about shorting the Qs. If you take a look, though, at the IWM today, it's up some 5%. I'm short the Qs, which is only up about 3.5%. People, that still works. It's still profitable, along with the fact that I've got a back ratio inside of the IWM to kind of offset, again, a larger degree of risk. Now, as I said a moment ago, I wanted to dig just a little bit deeper into this marketplace and give you a bit of a feel. Again, if the market continues to rally, I'm going to continue to allocate capital, all right, as we've actually broken that very, very tight spider range. One of the other things that I've done recently, okay, and more specifically in yesterday's trade, I actually allocated myself into an iron condor inside of the spiders. Now, for those of you that speak a little bit of geek, I know what you're thinking. You're like, wait, you just did an iron condor? Okay, yeah. But I bought the iron condor. I didn't sell the iron condor. And that trade is actually paying quite nicely in just the past 24 hours. So I've been on the buy side, again, the buy side of premium. And that's also why I wanted to detail back for a second and swing back over to the S&Ps. I'm watching the edge of this expected move, okay, with such intensity. And I'll tell you exactly why. Right now, okay, kind of ironically, I'm actually making a bet that we move outside of the expected. It doesn't necessarily have to be this week, but I'm looking for outsized moves by effectively having purchased an iron condor. Most of the time when you have an iron condor on, okay, it would look something along the lines of this. No. Okay. I've actually got one of these little monkeys on. All right. And I'm looking for a big move up or a big move down inside of the marketplace. Well, and I wrapped that iron condor right around the range that we talked about inside of the spiders the other day, which is that 270 kind of 290 range inside of the spiders. Now, last portion of this that I kind of want to detail. In no uncertain terms, we are far from out of the woods inside of this marketplace. Okay. One of the things that I'm going to start laying on and layering a couple of positions into here happens to be the bond market. Okay, as I was saying a moment ago, the Fed announcement today had absolutely no impact on here. I think the bond market is going to be a great opportunity. Here's a marketplace that is well positioned to see a rip to the upside or the rip to the downside, and that's exactly what we're going to start to trade for. So we're going to look at things like back ratios, infinity spreads, specifically inside of the bond market, because one of the things that the Fed did not say today, they didn't say that they were going to target interest rates, which means these rates here in the TLT, these things should be free flowing. Okay, even though we've seen really, really low volume inside of the bond market lately, let's look for them to start rocking back to the upside. By the way, as the bond market starts to rock, okay, either direction, I should clarify that. If the bond market starts to rock either direction, I want to be involved in it, but that's also going to be a big player and a big mover for the S&Ps. Last bit of analysis I want to give you here happens to do with the volatility. And I talk about this almost every single video that I would do here in terms of these evening videos. In terms of volatility, let me actually lead off right now with the VVIX, okay? The volatility index holding still above. And again, this one's fairly shocking, holding still above the 110 region. So one of the comments I made just a moment ago is like, I don't want to hear like, that's it. They're waving the all clear flag. Okay, really? Because in everything that we know about the marketplace, okay, a VVIX, the volatility index above 110, okay, prototypically means duck and cover. Now, maybe we're in a new paradigm of volatility, and there's this bit just a monumental shift, but we don't think so. Okay, we look at the VVIX and know better. Effectively, what it means is the professional world is still actually hedging. They're still hedging, okay, and buying options specifically in the VIX to hedge. Hence, why the VVIX remains relatively high. The other aspect that's still really kind of almost shocks me in this case, happens to do with the volatility, okay, futures. If you take a look at the volatility futures, we are still, okay, in technically an inverted kind of stance with these volatility futures. They just refuse to kind of resume a much more normal, okay, pace. And that is what I'm looking at is these 21-day volatility futures are still trading 31.95. Even though it's negligible, okay, the volatility futures are still, again, in an inverted stance. And that means short duration risk still exceeds, okay, longer duration risk. And any time, okay, that we have this combination, and we have this combination right now, and it really is the perfect storm of what? The VVIX that's still elevated, right? We have the volatility futures that are still inverted, bonds refusing to move over here, okay? This is still very much anybody's marketplace. And I want to continue to reiterate, you may see a rip and rally over here. Listen, what is going to involve in this marketplace is going to take time. No one should sit behind their screen and think, I missed it. That could have been the best buying opportunity of my life. Okay, guess what? I missed it. And I don't look at it as missing an opportunity at all. Okay, I am actually long short right now. Still got net some negative delta with the marketplace even going up. This has not necessarily been, okay, devastating. This is about hedging. And again, it's about sector rotation. With that, I'll detail much more of this inside of the TheoTrade chat room in the next 2 days of trade. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.